companies like tech stocks. Yes, tech stocks. They're just very strong businesses with suddenly very bad stocks, at least for now. At the risk of stating the obvious, what we loved about the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, which reported tonight, Nvidia, and Tesla, what we love was that rates didn't matter to them. They had such strong businesses. That's how they could go up for most of the last 2 years. They're the ultimate secular growers, which is why they didn't get dinged that badly by the Fed rate hikes. But the flip side of that is that they won't really benefit as rates come down. The Magnificent Seven, the companies, will be doing just fine, regardless of where the Fed takes interest rates. But their stocks, very different story. The answer is their stocks are and will be losers. And they'll probably keep losing until their shares come down enough to look cheap versus the rate cut winners that are rallying now as part of the great broadening. Now, that could be some distance from here, which is why one of the reasons that when you see a weak number from any tech company, like tonight with Microsoft, sellers just come out of the woodwork and they just blast the darn thing. I mean, it's just incredible. People don't even know how it's doing, and they just sell it. For tech, the watchword is 3 words that my staff loves to be able to say. And those 3 words are, get out now, which is a fabled reference to something that I did when, if you have Read Confessions of a Street Addict, I should have bought all those companies and crunched them, except for I wrote it. Consider the case of Nvidia, which is doing amazing things with generative artificial intelligence, generative AI, and accelerated computing. Those are the 2 biggest trends of our day. Those are basically their own cycles with their own rules, and they have nothing to do with the Fed. That's something we love them for. Not anymore. That's how Nvidia stock has become a wasteland. I mean, it's this interstitial gunfire. I mean, every day. I mean, thank heavens that the market stops. Thank heavens they ring a bell. Because then it can stop going down. Okay, sure, it's still up 110% for the year, but it's now down more than 35 points from its high, 140 to 140. I don't see it stopping here. That's not because Nvidia's business has deteriorated. Its products are selling amazingly well. Its competitor, AMD, on tomorrow and Squawk on the Street saying good things. It's because Nvidia doesn't benefit from rate cuts. So its stock gets kicked to the curb in this environment. The money you get back from selling the company's shares that are being redeployed are to the rate cut beneficiaries. No insult to Nvidia. It's about the stock, not the company. So why not get rid of the stock? Because Nvidia stock is getting cheaper as it goes down. Right now, the street expects them to earn $3.59 per share next year. But if this is anything like the Nvidia we've seen in the last decade, those estimates are probably way too low. Maybe so low that the company could eventually earn $4.59 per share next year. In that case, you've got a stock that's conceivably selling at less than 23 times next year's earnings. I am not selling the greatest growth stock of our generation at 23 times earnings. I'd rather risk taking some pain. And maybe then, keep in mind, Nvidia is the premier growth stock of our time. I'm going to say it again. It's not going down just because skeptics feel there's no good return on investment AI. It's going down because Wall Street's become a lot less willing to pay up for the earnings of growth stocks. It's called multiple contraction. Right now, investors would rather chase cheaper stocks of companies that will get a massive earnings boost from lower interest rates. Think Stanley Black & Decker. Wall Street at certain junctures falls out of love with great growth stocks, abandoning them for cyclical stocks that will do much better in accelerating economy. The year-over-year comparisons are just much better with these rate cut beneficiaries than they will be with the Mag 7. The market runs on these companies. But at some point, a stock like Nvidia gets so cheap, so darn cheap, on an earnings basis, can you believe it, that the selling will stop? We just haven't reached that level yet. I don't mean to be picking on Nvidia. Microsoft, Meta, Amazon, Apple have all been experiencing multiple contraction. Meanwhile, stocks like Stanley Black & Decker or the banks are experiencing multiple expansion. Glorious. Now, we hear that many smaller cap stocks are winning here. It's the big techs donate share to them. Donation is a very tricky word, though. What's really happening is that big institutions aren't doing anything different than they usually do. They always sell the stocks that don't need the Fed to make the estimates and buy the stocks that will put up huge year-over-year earnings growth with the help of rate cuts. Of course, there are stocks that are basically bits and bobs. Procter & Gamble and Merck missed the numbers today. I can tell you if it weren't for China, those stocks would have actually gone higher. I'll go over China losers later in the show. Eli Lilly keeps going down because it's been up a lot. It suddenly has GLP-1 competition. But it's also suffering from the same multiple contraction as the Magnificent Seven. We don't know when that will stop either. A quality company, real bad stock. It's so easy to just dump all the great growth stocks that have done so well when you have cycles based on cell phone refresh or PC refresh or AI or accelerated computing. You sell them and you will feel so instantly relieved. You'll be like, oh, a steamer trunk removed from my back. Never forget, though, that you're selling winners, actual bona fide winners for stocks that were losers just 2 weeks ago. Selling winners for losers is indeed a longer term a mug's game, unless you think this rotation has immense multi-year staying power or you're a hedge fund with the ability to flit in and out all day and all night. For the Chapel Trust, we've trimmed many of the amazing winners of this year to buy hitherto losers like Stanley Black & Decker. We could bask in the win, if only because but we can't because we still own so much of the Magna 7. But like politicians, we must ask ourselves, are you better off now with the cyclicals than you were with the secular growers? The answer, here's the bottom line. You're not better off if you only own the cyclicals while waiting for the rate cut cavalry that never came and still hasn't come. But unless you think that Nvidia's General Custer, you should come out ahead when we fully discount the rate cuts that are ahead, even though there could be plenty more pain than we have so far had with the great broadening as it unfolds.
We went below the 20 MA on the weekly chart. You can see it here. But today we reclaimed the 20 MA on the weekly, and to now at 12 o'clock US time, we are above the 20 MA, and it looks like yesterday's sell-off didn't even happen. So what are we going to do here? Is this the right time for long-term investors to buy into the stock? For today, I think there's no reason to chase Nvidia, and we will see. Today there's the Fed meeting, and we have to wait and see what will happen to mega cap tech after today's statement. In my opinion, there is still room to the downside to this double top at 95, and then the gap. We'll have to see whether the gap will be filled in the next few days. Today is the last day of the month, so there's the monthly month-end markup going on, and so who knows what August will bring with downside follow-through. But if we get down here to the 95 area, this might get even get more interesting again, because I think, like everybody, this might still be a long-term AI winner. So the question is for everybody, when and how to get in the stock. So I will wait to see whether this is a bounce that will go down again, or if the stock stabilizes here, this might be a good area to start a position or to increase the position. Okay, that's it for today.